Personal finance number 4A, list the factors that affect credit worthiness. Lots of factors can affect your credit. Number one would be paying your bills on time. You can't be consistently late and being reported to creditors. That will just destroy your credit. Number two would be to have some credit cards and use the credit cards, but use them for $200 a month and pay them off. $100 a month, pay them off. And what they call that is good revolving credit. You use them, you don't run them up to 2,000, 3,000, 4,000 max amount and then just pay the minimum amount. That doesn't help your credit, obviously. But if you use it but then pay it off, it shows that you have excellent revolving credit. Another thing sticking with credit cards is to not have a bunch of credit cards with high limits on them, max limits, because it's still viewed as available debt, meaning that I could go out, if I had 6 credit cards with $30,000 on them apiece, I could very quickly go out and spend $180,000, and even though I was not in debt today, could be very much so in debt tomorrow. So that's not viewed as a good thing. Keeping lower limits and keeping them paid down is a good thing. Keeping your credit cards for a long time, establishing that credit card limit, that credit card relationship or a relationship with the bank, and continuing to do that for a long time. I've had my credit cards for 15 years and counting, and I have not changed. I haven't dropped them. I haven't added another one. Just keep on. I have 2 and just keep on rolling along. So it's a good thing to do if you're responsible with that. Also, paying your mortgage off, paying your student loan off, paying a car off, having assets, different types of assets that you can borrow against. These are all things that help your credit. Having a job, in one place for several years. These are things that help you build up your credit score. A good credit score is pretty much today anything over 720, the highest being 850 of a combined score of 3 different credit agencies. So that should help you understand a little bit more about credit. Personal finance number 4B, compare interest rates on loans and credit cards from different institutions. A credit card loan is typically the highest loan that you can possibly get. I would strongly advise not getting a credit card loan. I would rather you, if you needed a loan, go to the bank. Okay, go to a credit union. Go to them, take your credit score in, and let them check your credit, and try to get and negotiate a low interest rate. Paying on an adjustable rate of a credit card is just a not smart thing to do. And you will pay dearly for that, because they typically are upwards of 20 and 30% on credit card loans for young people. Personal finance number 4C, explain the difference between simple and compound interest rates. Okay, a simple loan would be one where you go in and typically those are less than $10,000. You go in, get the loan. You pay interest on a loan. If it's 8% interest, you'll pay 8% plus your principal. Pay it off over a year and it's done. A compound interest loan would be your mortgage. That gets a little bit different, because you're paying interest. Every single month you're paying interest on what you have borrowed. Typically you'll pay more interest on your mortgage over a 30-year time period, maybe even twice as much more than your house is worth. Okay, so at the time that you bought it. For example, if you bought a $200,000 home at 6% interest, you're going to end up paying over the long haul about $480,000 total, which would be $200,000 for your principal and $280,000 for your interest. So you're going to actually pay more than twice the value of your home just for your interest. So that's a compound interest, and then a simple interest loan is just where you take the interest, add it to the principal, and divide it and pay it off over a period of time.